Hi, welcome to Finance Decoded. This video is a continuation of the one about net present value. And in this video, I want to discuss some further considerations regarding practical aspects of calculating NPV. I already told you that investment appraisal is usually a topic that appears in the ACCA FM exam. Okay, so you can be sure or almost sure that when you take your exam, you will have to solve some questions and answer some questions about NPV. Okay, and in most cases, there will be an open-ended question where you will have to compile the cash flows needed to calculate the NPV. Okay, so unlike in these very simplistic examples that we solved together in the previous video, those cash flows will not be given to you. You will have to compile them. Okay, and potentially you will receive a whole set of information, set of data, and you will have to figure out which of the components are to be included in those cash flows and which are not going to be included. Okay, therefore, it is absolutely crucial that you understand what are the basic requirements regarding cash flows in the NPV computation, which ones are included, which ones are not included, and why. Okay, so let's look at those basic principles. So the first thing that we need to notice is that NPV is a prospective measure. So if we look on the timeline of the investment project, okay, and let's assume this is the moment zero where the company is expected to make the initial investment of 170,000 euros, and then in the future, okay, there's this time horizon of the project and the future expected cash flows of the project, okay, and so on. Okay, these all cash flows are going to be taken into account because these are future cash flows. Okay, and I'm emphasizing that because in many cases, at the initial stage, I mean the preparatory stage of a project, a company is already incurring some costs, okay, some expenses connected with preparation of the future investment prior to making the final decision whether the investment will be undertaken or not. For example, we can assume that 1 year before the start of the investment, the company spent 10,000 euros on market research. Okay, for example, to find out if the product that the company expects to make, within this investment project will be marketable or not. Okay, now from the perspective of NPV, this cost connected with the market research should not be included in the calculation because it is the so-called sunk cost. Okay, sunk costs are not included by definition. Okay, however, in practice, sometimes it is difficult to figure out what is the sunk cost and what is not. Okay, because in some cases, in this preparatory stage, just before committing to an investment project, a company or a different investor buys assets which are later used in the investment. Okay, so for example, you can assume that the company 1 year before start of the investment project paid 20,000 euros for a piece of land, and then this land will be used in an investment. Okay, so now we can think, about this purchase of land in terms of whether it is a sunk cost or not. Well, intuitively we feel this is not a sunk cost. Okay, in fact, this piece of land that the company bought and which will be then used in this future investment. Okay, we don't treat this as investment as sunk cost, but instead we include this in the initial investment of 170,000. Okay, it is simply the case where the initial investment does not only include pure cash that is needed to be injected in the investment project to launch the process, but also the company may use assets or other resources in nature and commit them to the project. Okay, they simply constitute a part of this initial investment. Okay, a crucial remark here, however, is that if the company, at the stage of calculating this 170, this initial investment, okay, that will include this land, okay, this land will be included in the 170, not at the historical price of 20, but at current market price from time 0. Okay, so if the price of the land went up, for example, from 20 to 25, okay, the company will take 25 and include there. Okay, good. Now the next information about which cash flows should or should not be included in NPV will rely on the fact that NPV is based on the so-called incremental cash flows. Okay, so this term incremental means that in the calculation of the NPV we will only include cash flows that will appear, okay, and this relates both to negative and positive cash flows, okay, cash flows that will appear in the future if and only if the project is undertaken. Okay, and again, here you have to be very careful, because in many sources of information which are used to compute the cash flow for NPV calculation, many numbers may stem from allocation of costs. Okay, so if there is just a change in the structure of costs in a company, then such a change in structure does not, in many cases, represent an incremental cash flow. Okay, what I'm talking about in most cases relates to the so-called cost centers. Okay, so cost centers are units, okay, parts of the company that don't produce anything, but it costs something to keep them. Okay, so obviously in every company we have an IT department which doesn't produce anything, okay, but we have to maintain it, HR department, finance department, okay, security department, okay, all those departments, okay, we can put them in the group of administrative department. Okay, they are cost centers. Okay, and in many cases, people who prepare managerial accounting reports, they like to allocate those centrally incurred costs in a company to see how much a certain business line, certain unit, certain subsidiary or certain project can be burdened with that type of cost. Okay, so here we can have a simple example of this allocation, see why the change in the allocation as such is not an incremental cash flow. Let's assume that we've got a company that has an administration department which costs the company 100,000 euros per year. Okay, and the status quo is that the company right now has 2 projects, okay, or 2 products. There's product A and there's product B. Okay, assuming that the current allocation is that 50% of the administrative expenses are allocated to product A and 50% are allocated to product B, okay, clearly in the managerial accounting report, there will be a cost, administrative cost of 50 allocated with product A and 50,000 allocated to product B. Okay, and let's now assume that this company is expecting a new investment project. Okay, and this project is all about producing product C. Okay, so if this product C doesn't change the total administrative, the total costs connected with the administrative department, nothing will change except for new allocation. Okay, so the new allocation can look, for example, like this. I mean, now there is 100 and it has to be split into 3 different products. Okay, 33% allocated to each. So this 100 now will be split into 33 product A, 33 product B, and 33 product C. Okay, it is obvious that if we are provided with this information and we are computing the cash flows for the NPV of this product C, then it is clear that this 33 is not incremental. Okay, it's not a cash flow, it's just allocation. Okay, however, if we assumed now that product C will require increase of administrative expenses from 100 to 112, then it is obvious that we do have an incremental increase. Okay, the plus 12 is incremental and should be included in the NPV calculation, irrespective of how the new allocation will be done, how the company will take the entire 112 and split that. And now finally, the last thing I want to talk about is the fact that NPV is a measure that uses cash flows. I mean, I said it already, but I guess it needs to be said again. It's based on cash flows. So if we have some costs or revenues which are non-cash items, then it's obvious that they are not included in the calculation. Okay, and the most often used example of such a non-cash expense would of course be depreciation. And I believe it's absolutely clear to all of you after the exercises that we made about the accounting rate of return and the payback period, the depreciation is not included in the NPV, okay? Just because it is not a cash flow, right? But on the other hand, you have to remember that depreciation is an expense also from the tax perspective, okay? Depreciation is tax deductible. Okay, and it's quite obvious that the additional tax that the company will have to pay on the profits made on the new investment project are incremental cash flows. Okay, so if depreciation, which is not a cash flow, impacts the effective tax rate of the company, it is absolutely clear that the additional tax or the tax shield, tax saving that the company achieves on depreciation of new assets that are purchased in connection with a new project is incremental. Okay, so the tax savings are incremental. Calculating tax savings is a topic that I will discuss in a new video, which will be devoted to a concept called TAD, or tax allowable depreciation. Okay, so if you don't get the idea of the tax saving that is connected with depreciation right now, don't worry, I will explain that in more detail later. Okay, so summing up, in NPV, you take into account future cash flows, you skip the sunk costs. Okay, you take into account incremental cash flows. Okay, so only the ones that will appear when the project is undertaken, and you don't take into account non-cash expenses and non-cash revenues.